Hello, I'm Rob from Federal Finance CPE. Today we're discussing commitments in federal accounting. We are going to talk about what they are, how they are used, and go through a relatable example using an everyday situation. Think of commitments as the planning stage of federal spending. It's when we raise our hand and say, we have a plan to use this money, but haven't made any legal promises yet. This discussion is a perfect companion to our obligation discussion because commitments come before obligations in the federal spending lifecycle. Obligations are the legal promises to pay, and commitments are reservations of funds that we'll need. All right, let's take a look at what we'll cover today. Our chat about commitments break down into four main parts. First, we'll start with the fundamentals. What exactly is a commitment? This will give us our foundation for understanding how federal agencies use commitment accounts to plan spending. Then we'll explore commitment accounts, the specific United States Standard General Ledger accounts we use to track our planned spending. You'll notice these are the 4700 series, which comes right before those obligation accounts we discussed in the other video. Next, we'll talk through the commitment lifecycle, seeing how these accounts flow and evolve from allotments to becoming obligations. This is where we'll see how commitments fit into the bigger picture of federal spending. Finally, we'll conclude with a case study. I love using these case studies because they show us how these concept works using everyday situations. The flow of budgetary accounting. Starting from the top, we have appropriation. That's Congress saying, here's your money. Then there is apportionment, where the Office of Management and Budget, OMB, divides that money up by time period and purpose. OMB shares apportionments by creating an SF-132 or apportionment schedule. Think of apportionments like an allowance for the quarter. Next comes allotments, where the agencies divide their money between programs. Agencies allot funds across their organization, so think of allotments as your piece of the overall allowance that your agency got from OMB. Now, here's what we're focusing on today, commitment. Notice how it sits between allotment and obligation in our flow. This is because a commitment is your agency saying, we plan to use this money before you have an actual legal promise. Think of it like planning a vacation. Before you start making any reservations or obligations, you set aside or commit money in your budget for the trip. You haven't spent it yet, and you haven't promised it to anyone, but you've marked it as planned to use. So what is a commitment? Let's look at the definition from the Federal Budget Glossary by the Government Accountability Office, the GAO. It states that a commitment is an administrative reservation of allotted funds or other funds in anticipation of their obligation. Let's break that down in some plain English. It's an administrative reservation, so it's an internal accounting tool or budget tool. It involves allotted funds, money given to your program, and it's anticipation of an obligation. So this is planning for future spending. A real-world example might be when your agency knows they need to buy new computers next quarter. You create a commitment for the estimated costs. Now, even though you haven't signed any contracts yet, it's commonly the first step of the procurement process where you start recording commitment accounts. Let's get familiar with the two main U.S. Standard General Ledger accounts used to track commitments. First, we have account 470000, commitments, programs subject to apportionment. This is where you find most of the commitments will live. You'll use this account if your program needs to go through the apportionment process. Next, we have 472000, commitment programs exempt from apportionment. Some agencies and programs have special authority to bypass the regular apportionment process. Now we're getting into the exciting part, seeing how commitments flow through our federal accounting system. Just like we saw with obligations, commitments have their own life cycle. But there's a key difference. We're tracking our spending plans instead of tracking goods and services as they are received. Think of this life cycle as a journey your financial plan takes, from the moment you said, we should set aside money for this, until the plan turns into an actual obligation. Now, let's observe how commitments flow through a system by following an example here. This diagram shows commitments flowing from allotments going to obligation, just like our flowchart earlier. When you get an allotment in federal accounting, it's like getting your budget for the period. Then, before you obligate or remember, legally promise any of that money, you create commitments to plan how you'll use it and set it aside. So now it's time for a case study on commitments. Let's start our story of commitment planning with mom and brother. First, we have mom, and she's been thinking about buying a plane ticket recently for an upcoming trip. Next, we have your brother, who's been eyeing a new computer for a while. Think of these two like different divisions within your agency, each with spending needs and plans. Mom's travel plans are like your agency's travel budget commitments, while brother's computer plans are like your IT procurement commitments. So here's where our financial story starts. You can see we just loaded on our system an allotment for $1,500. This is like your agency saying, here's the money you have to work with for the year. This $1,500 is what I like to call our commitment ceiling. You cannot commit to spending more money than this amount. These empty commitment boxes are like blank commitment forms waiting to be filled out. Think of them as 4,700 accounts we discussed earlier, ready to track each planned fund use. Right now they're empty because even though mom and brother know what they want to buy, a plane ticket and a computer, they haven't actually committed to specific amounts yet. Time for our first commitment. Mom has done her research and figures she needs to commit $750 for a plane ticket. Meanwhile, brother has also entered his first commitment of $750 for his planned computer purchase. So look at the math here. We've each committed $750, totaling $1,500, which matches our overall allotment. So you'll see allotment balance is now 0. Watch what happens to brother's commitment tracking now. His original $750 commitment is split into two parts, being $500 for the computer and the remaining $250 outstanding. Mom's commitment stays steady at $750. She's still confident in her travel cost estimate. This shows how different parts of your agency might have various levels of certainty in their planning. Here we see a new potential commitment need arise. Now you've been meaning to give your neighbor a gift for a while, so you're going to include them in your plans for committing funds. We know we had $250 left over from your brother's computer. What we've done here is decommitted or reduced your commitment balance. Instead of having a purchase, we're just taking that commitment balance and bringing it to 0 for your brother. What we're able to do then is move it over to your neighbor and have a commitment for them. Their needed purchase was an aquarium that they had estimated $250 for. Turns out they only needed $200, which gave us a remaining balance of $50. Now, we didn't need those $50, so we were able to bring that amount back to our overall allotment balance. Now, looking at the tracking boxes, we can see mom's commitment remained at $750, and we ended up using all of that for purchasing plane tickets for the obligation. Her overall commitment balance is now 0. Your brother started with $750. He had $500 for an actual computer that he obligated for, and then we reduced the remaining $250 to bring his commitment down to 0, which we moved that balance over to your neighbor. We ended up only using $200 for obligations for the neighbors, so we had a remaining $50, which we then decommitted and brought back to our allotment. We've come to the end of our journey through commitments. Let's recap our key takeaways. Commitments are administrative reservations of funds. They must be supported by available allotments. Every commitment needs to be tracked separately. And most importantly, you can't commit more than you have. Those interested in learning more about federal accounting topics can visit Federal Finance CPE's website at www.federalfinancecpe.com. This training was brought to you by Persons Consulting LLC, a service-disabled veteran-owned small business specializing in federal financial management and training.